What's my absolutely favorite chart right now? It's not an individual stock. It's not even a stock index. It's not a currency. It's not a commodity. It's actually implied volatility. You see, implied volatility is one of those things that tells us how investors are positioned. Are they fearful or are they greedy? And remember, the market always oscillates between these two extremes. People are either greedy or fearful. And so what we've seen of late is that the implied volatility of the S&P 500, it's measured by something called the VIX, has been really giving us a lot of clues as to what the market will do over the coming 2 weeks or so. And that isn't always as clear-cut as it is right now, because right now we've had a very well-defined trading range in the markets, and I do think ultimately that will probably continue for a good part, if not all, of 2019, as stocks are probably largely capped to the upside in the bigger sense. So to give you an idea on this, I made a little chart that I'm going to show it to you right now. So what I crafted here is the implied volatility, which is the chart in green. Let me get my tripod here correctly. And I want to just help you contextualize how you can make money with this, like right now. So you can see as implied volatility spikes from the VIX. The VIX this year so far has gotten oversold when it was around 13. Sometimes as low as 12, but between 12 and 13 is kind of the low end. And it has on average gotten overbought as it started creeping above, let's call it 16. And if we measure this against stocks, which are up here, let me get a pen, you can see that as volatility spiked above 16, then stocks ended up getting oversold and they ended up being a buy in the dip. This happened here in March, for example. It happened again here later on in March. And it again just happened just recently as implied volatility spiked actually to the highest it's been for most of this year, which was closer to 24, and the market sold off and it's now bouncing a little bit. So I think right now what's happening is that the implied volatility is breaking back below into this area where between, let's call it 12 and 14, where year to date, stocks have then gotten overbought and implied volatility too complacent. So I think we're once again entering a period in the market where we are probably better buyers of protection than otherwise. Now, it is important to note that we do remain in a highly risky environment in the sense of headlines, and I don't think that's going to go away anytime soon. I think these U.S. China trade talks and figuring all that is going to take some more time. So there's always risk for on positive headlines for markets to rally and implied volatility to come down, and vice versa. But that's exactly where this chart comes back into play, right? So then when implied volatility gets too low, you have an opportunity to essentially be short stocks or sell stocks, versus if implied volatility gets too high, you have an opportunity to basically buy stocks. So I hope this is helpful. This is my favorite chart right now. And again, it's not always as straightforward as it is right now. When you have prolonged rampant bull markets, then the VIX tends to remain low for a lengthy period of time. But we're in a very choppy market, and I do think this is working out really well. It has so far this year. Hope this helps. See you soon.